I'm going to explain every recession since 1980 as to why I don't trust the yield curve inversion. Brief recap, we're talking about the yield curve inversion, in which right now the 10-year treasury yield is lower than the 2-year treasury yield, suggesting that the big money thinks that economic times are going to get worse than they are now. The reason why people are so freaked out about it is generally a recession seems to happen after the yield curve inversion. Here is a chart illustrating that inversion, and yes, this is my head as a cursor. It literally is the 10-year treasury yield minus the 2-year treasury yield. Whenever that number is negative, then the blue line goes beneath the white line. We are inverted, and generally the economy is not happy. Now, the early 1980s was pretty much two recessions jammed into one, and you can see there was a huge difference between the 10-year and the 2-year. This was caused by the Federal Reserve's tight monetary policy, and I'm going to show you. When I talk about tight monetary policy, I'm talking about the Federal Reserve raising interest rates. I just made a chart comparing our interest rates to our inflation index. A lot of people don't like the CPI, so I'm using the PCE, which people consider to be better, and then I'm comparing unemployment rates. Remember, I'm talking about the recessions in the very early 1980s, which is this time period right here. You see we have high interest rates, we have high inflation, and we have high unemployment. When I say high interest rates, they were at 20% in the early 1980s. Right now, they're 5.5%. Inflation hit over 12%. Unemployment hit about 11%. Our inflation is at 3%. Our unemployment is at 3.9%. So compared to the 1980s, our monetary policy is nowhere near as restrictive. And look, 1990, 1991, yield curve inverts, and we do have a recession after. That was caused by tight monetary policy and also the oil shock during the Iraq War. Interest rates were at 10%, inflation was almost at 5%, unemployment rose to about 7 to 8%. The United States doesn't have the problem that it did in 1990 because we are producing more oil than any other country has in the history of the world, meaning we are much more insulated against oil shocks. Next is when the yield curve inverted around 2001, we had a recession after the dot-com bubble, but worst of all, 9/11. To be honest, it was really 9/11 that caused the recession, and we recovered fairly quickly after that. Now, it's true, no amount of fiscal policy could prevent terrorist attacks. That's just something we always have to be ready for, but I believe we are much more vigilant now than we were, let's say, 20 years ago. Then, of course, there's the yield curve inversion of the 2008 recession. But here's the thing, it didn't invert in 2008, it did it around 2006. So the treasury market kind of warned us that something was going to happen before the real estate bubble collapsed. But because of all the banking and corporate corruption, it took a while for it to manifest, and it really hurt us all. More banks should have been allowed to fail. I think we should have bailed out US homeowners instead of corporate scumbags whose number one job was to make money, and they failed at it. But the thing is, it took almost 2 years for a recession to happen after that yield curve inversion. And it was a fairly minor inversion for something that was really so much larger and more catastrophic. So clearly it's not the size or the duration of the yield curve inversion that can determine the magnitude of the recession, which means that even though the yield curve has inverted quite deeply for over, let's say, 15 months, we don't know the magnitude of the recession. We had a mini recession during COVID in 2020 that ended quickly. That doesn't really count, especially because the US printed so much money that a lot of poorer people were actually able to pay their debts more efficiently than when they were employed. That lets you know we need to raise the minimum wage, we need to treat our workers better, we need to give our workers a lot more money than what they're getting paid. Every dividend and buyback that profited the corporations during COVID should be issued back to the taxpayer because they got that from our tax dollars. But let's go back to the chart where I compare interest rates, inflation, and unemployment. So for today, our interest rates are actually normal interest rates. Our inflation is approaching normal inflation according to the PCE. And our unemployment numbers are not that bad. I don't 100% trust this official figure because I think unemployment is a bit higher. Even though the entire US economy isn't completely on its knees, I think the average worker is struggling. My question is, where is the source of this inevitable recession going to come from? And when will this inevitable recession happen? 2, 3, 5 years? How accurate will the yield curve inversion be if it takes that long for a recession to happen? Look at this recession chart by Ben Cohen, and it shows yield curve inversion lengths of time and then the recessions that happen. You could see this is the biggest gap we've had from having a real recession in a very long time. My opinion is that 30 years ago, 40 years ago, the yield curve inversion would have been an absolute metric in measuring how the world economy acts. Since our last recession in 2008, we've had 14 years. That is a huge shift in how the world economy grows and focuses. There is also the emergence of an entirely new asset class into the world economy, that is Bitcoin and digital assets. This asset was introduced into the world economy in 2008 because of the failures of the dollar and the Federal Reserve System. It has gone from a market cap of a few $100s to now several $100 billion. It has a community that has a cult-like devotion to it, and it completely abhors the United States dollar and anything priced in US dollars. You see this peak right here and then this huge, massive drop? This low point is when COVID hit, the world economy started to fold in on itself, and guess what happened? Billions of dollars got invested into Bitcoin at this low price, and it triggered the crypto bull market. Or at the very least, it gave it a great deal of steam. From my research, it could go 50-50. If there is some kind of market crash, people might leave their Bitcoin positions and you will see the price of that asset drop dramatically, or the exact opposite. I mean, I literally don't know, but it is a factor to keep in mind. Either way, the world economy is an entirely different animal than it was since our last major recession in 2008, and I don't think the metric of the yield curve inversion is going to accurately represent the sentiment.